Hi traders, hope you had a wonderful weekend. So today we're going to look at my watch list for the week, but first a very quick recap on what to look at in the calendar. Now keep in mind we've got a lot of content on the website where all the analysts look through the upcoming events for the week and do a drill down of those key drivers, so I won't go too far or too deep into that. The main themes at the moment, obviously the US election has been a big driver for markets at the moment. The realization that Trump could be gaining some ground and potentially winning the election has seen the dollar and yields rise higher into last week. And if we keep on seeing polling data lean towards Trump, then there's nothing to say the dollar might not continue to go higher this week as well. So do keep an eye on election headlines and as the polling data, because as we should know by now, things can change very quickly, and that's where you get the bigger surprises. You've also got US data, which becomes increasingly important as the week progresses. The highlights being non-farm payroll on Friday and PC inflation, which is the Fed's preferred gauge, on Thursday. We've also got pockets of stuff like US job openings and consumer confidence as well to get us warmed up on the Wednesday. Domestically, we've got Australian CPI data coming out. I don't think it's going to do much of a favour for anybody hoping for rate cuts, looking at how I think the average trimming inflation past the pandemic has been around, I think, 0.9%, which is quite high compared to, say, the 4 years before it. But by all means, I'm sure that wouldn't stop traders trying to price in some sort of cutting if we do get softer figures than expected. But keeping in mind, the Australian dollar is under a lot of pressure at the moment, which I think is partly because of what's going on in the US election. So it's seen as a bit of a risk off if Trump is to win. And do keep in mind, we've also got tech earnings as well. So NASDAQ traders, be wary of that. We've also got Facebook, Meta, Microsoft, all the big names releasing figures this week. Also note that this is looking at Forex volatility for 1 week implied for Forex majors, and we can see that the yen 1 week implied is up to 13% annualized, and we're seeing rise in Aussie and Euro as well. I expect all these to be ticking higher as we get towards the end of the week, because next Tuesday in Asia time we have the US election. So we might find that because you've got so much data coming out this week, and that of course that election, the price actually could be really twitchy, and that means that you need to be a little bit careful. And I think it's possibly one of those weeks where technical levels might not be so useful all the time. So just keep in mind that, especially if you get to the end of the week, there could be some real big liquidity pockets developing and nasty price action coming because of it. So we will start off on the US dollar, but we'll actually start looking at data from the COT report. And there's three main things that came out of the data or jumped out at me this week. Traders have gone to net short exposure, or large speculators gone net short exposure on Euro futures. Asset manager gone net short exposure on yen futures, and large speculators are close to doing so. And in aggregate, or against all US dollar futures, they're now long the US dollar as well. Excuse me. So this top chart here is showing the net exposure of all US dollar contracts, and you can see it increased by 10.6 billion last week. So week over week, that's its most aggressive since February 2016. And that's quite significant because up until that point, a lot of the dollar rally, I believe, was due to short covering. And when you actually look through the data, it was because longs being closed, longs weren't really being initiated, shorts were being closed, and that's why it was rallying. What's happened since then is asset managers and large speculators are actually increasing their bullish exposure whilst also reducing their shorts. Whereas last week, large speculators have been generally wrong. They finally caught up and decided to go net long US dollar. Maybe that's a bit of a warning sign, if anything. But asset managers were increasing net long, and for the third week as well, and the dollar rose for a fourth consecutive week. Now we'll take a look at the dollar index, and it is a strong move. There's no denying that it's in an absolute epic move. Can't get my chart. There you go. So yeah, since that rally from the August lows, the 100 area, it's been absolutely relentless. You've seen pretty much 2 days of a very small pullback over that period. And in all honesty, this is a bit of a macro move, really. So in these sorts of moves, mean reversion, which I love, generally isn't working very well, and you need to just accept that sometimes. And on that note, if we see that we're getting more of the same from last week, and that is US data continues to outperform, Trump's ahead in the polls, then this could be looking at a move towards and even above 105 and maybe even up towards that July high. I'm just quite cognizant that as we get towards that election, we could get some nasty moves as people try to book profits, take punts ahead of the election. So it might get a little bit thankless. But for now, when you look at how prices are coming out the gates, it looks like the US dollar wants to continue higher. So with that, let's get onto the watch list side of things. And the Australian dollar, I think for me, is one to fade the rallies. And I put in the Aussie dollar weekly report that we've got this decent close beneath the 200-day average. And I wrote that any retracements towards the 200-day average might be seems an opportunity for bears to fade into. We've already seen that today. So you can see that it came in to that 200-day average, bar a few pips, and then rolled over back towards last week's lows. There's a few things to keep in mind here. First off, that the Australian dollar was actually lower for a fourth consecutive week. And RSI at weekly 2 is also oversold. It's by its most oversold level since early February. That doesn't necessarily mean it's going to go rally now. And again, like I said a few minutes ago, we're in one of these macro moves and mean reversion isn't really playing out very well. And if you look at what happened back in this period, we actually had 5 consecutive weeks and RSI was oversold for at least 2 or 3 of those. So we could be looking at a 5th week lower for the Australian dollar. And also notice that just a couple of days left of the month, we've got this very prominent bearish engulfing month at trend resistance. And that alone would suggest to me that any rallies we get on the Aussie is probably likely to be to the lower side in the current environment unless something drastically changes. So with that in mind, don't really want to be going low at these lows, but again, any sort of pullbacks I think that we could be looking at to fading into the rallies. So you've got a pretty bearish trend structure in the 4-hour. So maybe any moves up towards that swing high, maybe the September low, looking for another dip lower. In terms of support levels for bears to potentially target, you've got the 61.8 Fibonacci around 65.75. You've also got these weekly VPOCs. That's what that means is over this week, this is the most traded price by volume. And we had one, this is also the monthly one as well. So will it get to 65 cents? Never say never. I'm not forecasting that at the moment, but I think certainly if you're looking at the 4-hour chart, it's one to fade rallies into, looking for these such support levels potentially here. And then just common sense really, try and assess what's going on in the dollar index at the same time. How close is it trading to that July high? Because if it does get there, you've got a better chance of a base forming on the Aussie. Dollar yen, that's probably the cleanest one in terms of looking at being bullish the US dollar, and undeniably it's a very strong trend. It came racing out the gates thanks to the Japan's elections, but it looks like they're going to get hung parliament, which makes it very difficult to get policy over the line, and that's helped the Nikkei rally, and it's helped dollar yen rise with it. And you've got this very small 2-day retracement, lovely bounce off the 200-day average, and it's out the gates. But again, as always, do you want to be going in at the cycle highs in Asia? Possibly not. I think patience is always a virtue, and I found anybody who does this for any length of time will probably agree that sometimes it's better trading less, or sometimes even not at all, than just jumping in. And I think that's the case for here. We've got a really nice trend structure, but we're just off of the cycle highs of the day. So I think really it's a case of seeing how does it play out from here? How does Europe react? Will we get more of a pullback? If we do, potential areas to keep an eye on here, you've got the opening gap, which can act as a magnet, but it can also provide support. So you've got potential support around 152.23 to call it 153 even. So there's a zone there of potential support. I think the next obvious target is going to be 155 to 155.37. Which comes in at this pivotal level, which is support and resistance back in July. I think in all these, when you've seen a movement like this, I'm the one to be looking for the smaller moves within it, instead of going, okay, I think we're halfway there, let's just jump in with a wider stop and hope it gets to the July high. Again, we do have risk events coming up, and that could see a safe haven into the yen. And if so, we could see, let's say that Kamala Harris wins, we could see a reverse of recent moves, and that'd be a weaker dollar, etc. very similar in some ways, but not as established. Dollar Swiss. I need to tie some of this up. And what I like about it is you've got this strong move, you've got this multi-day consolidation, and now you've got some range expansion out of it again. If you look at this, the last consolidation, the end of last week, you've got the most traded price of that 86.58 area. So if we're lucky to get a pullback towards there, fantastic. We could maybe better position ourselves for a swing trade long. But I think at this stage, looking at the strength of the dollar and these highs over here, and the fact that traders are actually increasing their short exposure to the Swiss franc, which is what the central bank want to see, then dollar longs look more preferable to my eyes, at least, and for at least to move back up to these areas here. Okay, looking at euro dollar. Now this one, it's, how do I put this? It's one of these ones where you break it down logically, you wouldn't really want to be looking at longs on euro, right? But this would not be the first time that I've looked at a reversal just on charts and it's defied fundamentals. And when you take a step back and zoom out on the euro, you've got that long-term trend line, which has held so far. Maybe in a few weeks it will break. I mean, that looking at how strong that move is down towards it, got a little bit of a movement. I wouldn't be too surprised if you get a little bump higher and then it just crashes anyway. Trend lines do tend to sucker people in sometimes, but for now it is holding, and I do like you've got this confluence here. You've got it's holding above the August low. You've got a buyer bar. It did tap this high, then pull back, and so far it's holding above the August low. So I'm not looking for any heroic move here on the euro by any stretch of the imagination. But I do like there's a bit of a change in character on the 4-hour chart. You've got this pretty decent move to this swing high and a pullback. So that's last week's. So I think we could be looking at a bit of a cheeky move. And because the dollar's so strong, I'm not necessarily looking for a break of this swing high, but you could be looking at the range that is retraced from Friday's high. So maybe dips above the August low, just goes somewhere conservative, like just above the 108.20 level. And I think that looks more likely than simply smashing beneath that trend line for now. Also on positioning, we should take a look at that for the euro. This is probably a bit of a warning signal, if anything, but large speculators, what's going on with their websites? Large speculators finally flipped a net short exposure on the euro futures last week. Asset managers remain heavily net long, although they have reduced from, I think it's 345,000 to 193 since Q2. Oh, sorry, since July. So they are still net long. There's still a lot of money behind it, but large speculators who are generally leveraged, they are now net short, and you can see that they increased their gross short exposure for a 5th consecutive week. So they're piling into these. And that's feeding back into what I was saying, where you've got this move and it's holding above that trend line. So it's almost like a slow car crash. You're watching traders piling into shorts after an extended move, yet it's holding above support. So for me, it just backs up that large speculators haven't been that great at predicting currency movements lately. So maybe it might be time to fade them. And if we do get a decent bounce, the obvious level to look for maybe a bounce lower would be the 200-day average around 180.70 thereabouts. Now, if I'm looking at being potentially bullish euro against the US dollar, the mighty US dollar, and I'm looking at being bullish dollar Swiss, that would theoretically mean that euro Swiss has to rally, right? So I opened it. I don't really look at this very often, but I was quite happy with what I saw. And what you've got here is this really aggressive movement down and a V-bottom. V-bottoms can mark quite significant lows in the market. You've then got the September low was just above 93. And since then, the market's tried and failed to retest that September low. So you've got a higher low, and you've even got a double bottom, which forms kind of a higher low over here as well. And you can see that each rally, whilst it's petering out, to me, that the longer these levels hold of support, the greater chance I think there is of a strong movement higher. And again, remember, SMB want a weaker currency, so they're not going to fight you on this one. They're going to be quite happy to see Euro Swiss rally, and same with dollar Swiss as well. Again, I think because it's so messy, you really want to be creating value out of these moves, and by that I mean it's a bit scrappy. You're looking for movements back in towards the support to increase your reward risk ratio, in the hope that if prices do go into your favor, you're better positioned for that move, and you've effectively used either less risk, or you've basically got a much better entrance. So execution, or the entry, is really important on moves like this, where you can't be sloppy and go, oh, I'll just wait for a break above 94, because you've given up so much potential, and then I think you're kind of at bigger risk of maybe if you're lucky, a break even. So in terms of targets, I don't know, because I don't really have a fundamentally strong view on Europe, other than SMB want a weaker currency. But the obvious areas to keep an eye on here are the 94.89. So again, that's why the reward risk is really important on this one. Maybe back up to these highs here, but it's certainly one to keep an eye on as time evolves. Now, silver has caught my eye. And again, this is a very cheeky little move, nothing too heroic. But you've got this strong move, and large speculators, asset managers increased their net long exposure to silver for a second consecutive week at last week's data. However, we can see we did get this big sellers bar and a bit of a pullback, but it is trying to hold, for now at least, above these 2021, 2020 highs. Now, when you look at the structure here, you've seen similar moves where it's kind of pull back a little bit, false break, move lower, then reverses higher. It's one of these markets. It's like trying to wrestle an alligator almost. That's what it feels like. And I think silver's a little bit like that. So what I'm getting at is here, yes, this support holding, and I think we could be looking for a bit of a bounce, but I don't think this is going to be the end of the correction and we just go break to new cycle highs. What I have seen is a pretty ropey bullish wedge, and reiterate this most weeks, but when you're looking at these sorts of patterns, don't fall into the trap of doing the textbook stuff and just drawing pretty lines and expecting them to hold. I mean, markets are there to take your stops basically. So these are just to show you the pattern, but these are not lines to go, the market's not going to penetrate them, because my experiences are markets go for lines and then they stop you out and then they go where you thought they're going to without you. So it's just to show the general structure of what I'm looking at here. So there's not really a bullish divergence on the RSI 2 on the 4-hour chart. And you can even see RSI is pointing lower. So I'm not loving this, but for now, for whatever reason, you are holding above that tweezer bottom low at 33.28. You've got a 4-hour candle, half of it was lower wick. So it is trying to form a base. I just can't tell whether we're going to get another crack at trying to take out these lows before the reversing. Knowing silver, it probably will. But the general feeling here is that I think we're trying to get a bit of a movement higher. And again, it's quite scrappy, but I'd be quite happy if it went up to 34.80. Traditionally, bullish wedges will or you target the base of it at the highs, which would be 34 or 35 thereabouts. I'm not fully confident looking at this big sellers bar, so that's why I'm looking for a more subdued move, possibly another move low, but for now on the 4-hour I'm looking for a swing low, move up towards the 34.48 level. Just threw this one on at the end actually for oil, and this one is more of common sense approach really. So I saw it this morning, I had to double check that I was looking at the right contract. There's quite a gap lower on oil. You don't usually see such big gaps. And a popular strategy is trying to trade the closing of the gap. And I just think, do you have to target the whole gap? Maybe not. We might get, what I would like to see now is a series of candles supporting about the 68 level, maybe retraced towards the 70. That's a pretty big resistance level that it gap beneath, and I think that's a pretty obvious level for it to cap any gains as well. I'd be quite surprised if it just simply closes the entire gap and heads up for 71, 72 personally. Rule of thumb, which I'm not back tested, but it just feels right, is that the wider the gap, well, that can actually be a continuation gap. And really big gaps generally don't get filled at least immediately. That can go on for a very long time. I think that is such a big gap that I'm not expecting to just rebound and go lower. So two options or two ideas that come to mind are looking for dips around or above 68 with a view to maybe getting out before 70. And then assessing if we get a swing high, you might want to reconsider. Keep in mind that oil is a very choppy market at the moment. It's not nice. It's full of headline risk. So pretty technical lines probably aren't going to get you too far. And I think you're probably better getting in and out quicker and not messing around looking for any home runs in either direction at the moment. Now, there's not much to update on SP 500, but because it really is, to my eyes, one to just fade into the highs. And last week we discussed this and it worked out pretty well. At the time, I think market was trading somewhere around here and saying that, to me, it looks like the character's changed and any move towards the 5,920 area could be a cheeky short, but not necessarily looking for any home runs. And again, one level I pointed out was this high volume node here, and the market did eventually pierce that level and then form a low and go back up. But it's getting really choppy. Look, you've got this really big engulfing candle. It's trying to close it. It's such a chop fest. There'd be no crime in not touching this market this week, in my opinion. However, I don't really see an immediate need for this to simply head for 60,000, so 6,000. But if we do start coming up towards these levels, again, I'd be looking for a similar move down, keeping in mind that as the week progresses, we've got NFP, inflation. If they come in hot, will the market like that or not? We've also got the risk that traders will be looking at booking profits. If you've got a market that's trading near its record high ahead of the weekend, ahead of the election, I, for one, would probably be getting out. So keep in mind that that's maybe one to look at for as the week progresses. Shaky shorts at the highs, we'll call that. Quick update on the China A50 futures market, and it's just moved sideways. But as a quick recap, we had this 40% move up in 9 days or something. Gave back around half, maybe just under 2/3 of that move. But then we saw a bullish engulfing day. Since then, we've got a very nice consolidation that's holding up in the top third of that buyer candle. So now we've got a decent amount of consolidation. We haven't seen much of a pullback. Something supporting that market. Don't know who, but maybe it could just be one of those setups where you just lazily enter during the retracement, which we're already in. Question there is obviously, how do you protect yourself? Clear break. I mean, I wouldn't. The fact we're holding in the top third, if we got a strong candle into the lower third, I'd already suspect something was wrong. But we could be looking for a nice cheeky move towards 14,000 or maybe just a 2023 high. Not looking for anything heroic here either. At the moment, we're lacking the drivers. But hey, if we get some more stimulus headlines, maybe it'll just go back towards 16,000. I honestly don't know. But for me, it's, if you had to put a gun to my head, I think there's possibly a greater chance of it going towards a 2023 high before it breaks beneath, say, the May high. Dollar CAD. Look at Bitcoin before we wrap up. Dollar CAD isn't really set up as such. It's just a level of interest, and that it's come up towards that 139 level. It's kissing it perfectly. It's testing it. If you look back through time, it was the high back in November 2023. It was also a close high, not the intraday high, but there was obviously a bit of a shakeout and a false break above it in October 2022. And in August, we had another false break of 139. Don't know what it is about that level. And then we ended up with this bearish outside day. And that was the beginning of a long move lower. Now, context matters. I don't think just because we saw that candle there, and if let's repeat, we'd see a complete repetition of that move. We need to have a US dollar weak story. That's not really happening. But this might just be one to watch for educational purpose if there's nothing else. What's going to happen? Are we going to get some sort of false break? If I was to wake up tomorrow morning and see that we had a false break and a close beneath it, maybe we could look at the lower time frames and look at a cheeky counter trend. If we get a daily close above it, I think there's a reasonable chance that we could be heading towards that 2022 high. So it's not really set up as such, just a really interesting level to keep on your radars. And I'm going to wrap up now on Bitcoin. Because it's morphing and I'm changing my mind on it. So did a video possibly 6 weeks, 8 weeks ago, talking about this very, very strong move and this multi-month potential bull flag. But the character's it's just tortured. It's not a bull flag at all. It's so choppy, and you've got there's things I like about, there's things I don't. So I like that you've got this really strong rejection candle down here, which pierced 52,000 and came back up. And the retracement back within it ended up marking a swing low around 54,000 and high. But if you look at what's happening, the momentum higher here is nowhere near to what it was here or even here. It's making hard work of it. It did finally reach my 70,000 target. I think the week before, last Monday, in fact, and gave a 2-bar reversal. It's been very choppy. There's no immediate rush for this market to break above 70,000 by the looks of it. So for me, again, it depends on what happens in the election, I guess, as we get through the week. It looks to me like it might want to pull back. So the obvious level to keep an eye on was this swing low here, 65. So dip beneath 66,000, say, or these two lows. Maybe we're looking at a movement like that, an ABC. Nothing wrong with that. It's rallied into these highs. It's struggling to do it. But when I look at the weekly, it's harder to call it a bullish flag on there. So again, it's one for near-term trading. You've also got this spurious looking, not really an inside candle, but I just don't really love it. So it's a bit of a messy one at the moment. One to keep an eye on, possibly a pullback. In fact, I prefer to see a pullback, then we can reconsider longs maybe and see how it goes. So anyway, do you hope that was useful? And I wish you best luck with your trading, and I hope to catch you all next week.